All right, everybody, we've got one more panel before lunch. We're going to talk about a very important topic, strategies to secure funding for scaling decarbonization technologies from pilot to large-scale deployment. So to help crack the secret, I'd like to invite Bas van Beijeren, Investment Director at Carbon Equity. Next, I'd like to invite to the stage Gabriel, Managing Director and Co-founder at Prelude Ventures. Next, I'd like to invite Ilaria Rubbini, Investment Officer Cleantech Equity and Growth Capital Division at EIB. And our wonderful moderator, Gabriel Scheer, Senior Director of Innovation at Elemental Impact. Thanks.
Hello, everyone. This is obviously a very exciting panel because there are not one but two Gabriels on the same four-person panel, which seems highly unlikely. Obviously, also the two who are coming with American accents, so you'll have to forgive us for that in the current moment. You've already got your names up there. We've been introduced a little bit, but I'd love for us to kick off with the biggest question and sort of the fundamental question which we're here to think about. You all play different roles in the climate tech ecosystem, and would love for you to give a little bit of a view of what role your institutions play, and then share from your vantage point what you see as some of the more pressing and unsolved barriers preventing promising decarbonization technologies from securing the capital that they need to scale. Like I said, starting big, we'll go deeper after that, but maybe kick off with you, Ilaria?
Yeah, so nice to be here. A pleasure to be here. So I work at the European Investment Bank, and our bank is one of the largest multilateral provider of climate finance, and then also we are one of the largest venture debt provider in Europe. We provide capital to startup and scale-up companies, and we're financing their demo facilities all the way to their first-of-a-kind facilities across Europe. So it's EU27 and Iceland and Norway. And the EIB has, since the starting of their venture debt activities, we have now a portfolio of 7 billion and 300 companies. So we are trying to support the companies when they need the capital most, when they're scaling from lab or demo facility to pre-commercialization phases.
Gabriel, go for it.
Hey there. Thanks for having me here, Gabriel. Nice to see you. Prelude Ventures is an early stage climate tech investor. We're currently investing out of an $825 million fund. We have about $2 billion assets under management. And so what we can do and provide is we go very early, $3 and $5 million checks as our initial investment sometimes, or Series A, more like a $10 or $20 million check. But with our main fund and also then with a growth platform, we can support companies throughout their life cycle. So at Prelude, we invest across the economic and industrial landscape in things that are decarbonization or mitigation of climate change. But we invest in energy, we invest in food and ag, we invest in the built environment, we invest in industrials, those hard to decarbonize sectors like cement and steel. We invest in compute, mobility, and then carbon management. Those are our 7 verticals. To answer that quick question, I think the thing that most often we see that is lacking, or the differentiator between companies that are successful and grow and companies that struggle a little bit more with growth and therefore with future financing, is really finding a good, robust product market fit, really finding an economic value proposition. It's not enough to say, hey, we've got to do this because climate change. Like, nobody buys because climate change. Customers aren't there. They're buying because you have a product that is better, that is cheaper, that is more effective, a service that solves a problem, that solves a pain point for a customer. If you don't find that, if you don't discover that, if you don't get to that fit, you're not going to succeed as a company.
That's a great point. Buzz?
Great to see you all. I'm Bas van Beieren. I'm with Carbon Equity. We're a climate tech fund investment platform, and we basically try to get sidelined capital of private investors who cannot meet the minimum thresholds to enter any of the venture capital or private equity funds, but also work with a lot of family offices who don't have the expertise to navigate in the climate tech market. So we raised over 300 million, which we deployed across roughly 25 funds so far in really spanning from early stage to late stage climate tech, hardware, software, anything in between, in Europe, US. And we recently also launched an infrastructure fund of funds to really support the rollout of the projects. So we see a lot of the bridge as we are very early, but also very late stage. Especially in Europe, the capital or the bridge for that type of capital is very big. I don't think there's a missing middle or a gap for more software-like solutions. Can actually be quite expensive, or like asset-light type of solutions, but especially the first-of-a-kind plants, and especially in Europe, and when your first-of-a-kind plant might not be profit-making from the start, it's very hard to get the capital, and well, curious to have a discussion also with the EIB and others how we can solve part of it, and part of it might not be solvable, for a right reason, as Gabriel just alluded to.
Yeah, and we've got a broad mix, obviously, of sizes of funds and the areas you're playing. Buzz, just jumping in a little bit, you mentioned the kind of unusual model that you use to give people with less capital access to some of these deals, the infrastructure fund you just launched. Can you give a little more detail about how carbon equity works and how your approach is and what you then see as the gaps?
Yeah, so we're basically a B2C play. We get private investors as low as 10, 20K to invest with us, and give them access to the best climate funds globally by pooling their capital in a larger fund. We just raised our Fund 3, which was 105 million euros, and we deployed that capital underlying in 6 to 9 climate funds, really spanning from early stage to late stage, hardware, software, really trying to build a diversified portfolio for them, and then try to double down on some of the winners via our co-investment program. So at the core of what we do, we try to be meaningful within climate while also trying to make a good return. So we go really early stage, and we also support some funds that are really targeting that missing middle. But it's also an area where we struggle with because it's not easy to deploy there, and you really need large funds, a lot of expertise, and there are not that many out there. And there used to be a very strong governmental support in in the US. So we saw a lot of our US funds tackling these B and C rounds alongside a loan program or other IRA benefits. And I know we're going to touch upon it in a bit. We're gradually seeing that in Europe again. So we hope we can do more there, but also with our co-investment program, these rounds are also very tough for us. And then once companies go more later stage, then there's obviously a ton of capital. If you're gross margin positive and you're having tens or hundreds of millions of revenue, then all of a sudden there's a lot of capital. So, and we also deploy there. So we really try to deploy across the whole stack, but that missing middle is also something we struggle with.
Yeah.
Or the hard middle, maybe not missing always.
It's a great touch on the European ecosystem. EIB is one of the largest funders of climate finance in the world. You still list climate as one of the key things, and I say still in light of some of the changes we've seen in the world lately, as one of the biggest things you have as a focus. And I'd love for you to dig in a little bit on how you work towards the goal of mobilizing private capital towards a net zero world. You've got a lot of different angles, a lot of different arms. Give us a look at that.
Yeah, so the EIB try to support the companies out there, the clean tech companies out there, or the companies with sustainable technology or clean technology in several ways. So we do it via financial support, we do it with advisory, and we also do it with partnership with public funding as well. So I will touch upon all of this. So in terms of financial support, we have several ways of doing it. We have some colleagues now that are deploying the European Innovation Council funds, and that's really pure equity, and it's at the very early stage of the companies. Then there is our own venture debt, which is for more after Series A and Series B. Then we have project finance, which comes in for a larger size project that becomes more, bankable, or technology that are really proven. And then there is also corporate lending. So you really have, the EIB is really trying, always financing, clean tech and climate action and environmental and sustainability, but really trying to support the companies from the very early stage all the way to maturities. And then to advisory services, it's a team that provides technical and financial support. And this is really to try and help some of the companies that are a bit less sophisticated to become more bankable. So they help them with free advice on financial modeling, their business plan, or the way to see themselves also all the way to growth and all the way to become more profitable and really have a clear path before accessing actual banking financing. And then the last one is the EU, you probably heard of it, but the EU Breakthrough Catalyst Partnership. And this is a partnership between the Commission and the EIB and Breakthrough Venture Catalyst. So it's really to catalyze, funding for a project that needs to be scaled and that needs to, go from maybe demo facility with the first of a kind. And this is really a blended financing because the EIB provides venture debt, and then the catalysts provide grants, which is sometimes also what is missing to bring some of these very expensive technologies to more economic feasibility or profitabilities. And this partnership is really good because I think on the other side there is really like a way to look at it in a way that the product becomes really, there is an offtake agreement, and if there is not yet an offtake agreement, we structure it in a way that it becomes interesting for off-takers to come in and support the project so that the risks are not only on the startups.
Okay, and I want to go in the weeds a little bit. Give us an example of a venture debt deal you've done recently that helps to bridge that gap between the pilot and the commercial side of things.
So we have done a few. So one of them is Energy Dome. It's very famous. This is a CO2-based long-duration energy storage. It's an Italian company, and what we have financed with venture debt was a demo facility in Sardinia because they needed to prove their technology in a larger context, in a larger scale. So we have provided venture debt, and Catalyst has provided a grant. There are similar projects like that. We have done another project in which we have supported both the demo facility, so the tail of the demo facility, because there were other equity investors, which we complement. We are co-investors. We're trying to crowd in the capital, and then we are also financing the first large-scale facility, and this is a company in advanced material. And we have done also that in SAF with Ineratech, that is a German company. This is a very recent deal, and that's also one in which a Catalyst was involved. And again, there is a venture debt venture debt piece, and a grant piece. So we have several examples. I think these are all successful examples, and I think Energy Dome is one of the ones that is really taking off and is signing even more offtake agreements. So it's really nice to see that this collaboration is paying off.
Yeah, and that's one I'm personally excited about. We're also an investor in Energy Dome, and that project was so exciting to read about because of the collaboration between you, Catalyst, such a neat thing to see come together. Curious if you could please dive a little bit into the difference between the mandate of the EIB and the EIF, the European Investment Fund, and how you see those two playing alongside one another.
Yeah, so the EIF is a fund of funds, so they also support venture debts and venture capitalists, but they invest directly in the fund. It's a huge contribution because the EIF invests in almost all the funds in Europe. So and they have the same mandate in terms of climate finance and sustainability goals. So then they really do a due diligence of all the funds, and then the funds then trickle down to their own investment for startups or SMEs as well. They also provide guarantees to SMEs. So it's our cousin, and they do different things, but similarly, they reach out to venture debts and to startups and funds in that way. Yeah.
Love it. So we got two of the sort of very different sides of the capital stack. Gabriel, bringing it to you, you've been investing for more than a decade. You mentioned before a couple $1 billion, massive, like a lot of investments you've made, some of them getting quite far along, whether it's electric hydrogen, Form Energy. you've seen a lot of change. And I'd love for you to just start there of what's changed in the last decade plus of investing in climate tech in particular. What are you seeing as some of the sort of things that companies are struggling with now or proactively dealing with now in a different way than they were a number of years ago, specifically around capital?
Well, from the equity side of the coin, we went through this incredible period from something like 2020, 2021 through 2 or 3 years where capital was incredibly cheap. And so what that means is, as a company, companies went out and raised a lot of equity at really attractive valuations and were able to build and scale really, really quickly. In the United States and also in Europe, that was coupled with the availability of either government dollars, concessional capital, lots of other instruments that helped companies do first projects, to build factories, finance things with off-balance sheet, non-equity mechanisms to get really, really big, really fast. And the question that many of the companies are dealing with is either we did that well, and we now have a factory that's rolling products off the line, or that is about to start rolling products off the line that was financed with that cheap capital, both equity, debt, and government support and other, or we didn't do that well, and we didn't take advantage of it, and we're sort of, they are looking at maybe a squandered opportunity or a missed opportunity, and they have a big capital gap, because certainly that environment has shifted. The interest rate environment has gone from near zero or zero to, who the heck knows what the interest rate is right at this very moment. So that's a big shift. As a result, equity inflows into privately held and publicly held companies are drastically reduced. Capital seeks return, and also, it's a flight to lower risk assets. So if you're an early stage or a mid stage company, something that's still working to find that product market fit, still working to get the first of a kind facility going, then you have to adjust. So that was a generalized answer to the question, but it's been a dramatic shift. And you said over the last 10 years, 2015 capital was scarce. 2020 and 21, it was not free, but as close to it as we'll ever see in some short-term cycle. And now with the activity of the US government, with the Trump administration, I don't know when we're going to see capital returning to a more normal environment, either on the equity side or the debt side. So companies have to be really careful, really thoughtful, and treat every dollar that is in their accounts as, some of the last inexpensive money that they're going to have for the next 6 to 18 months, arbitrarily. And companies are shifting to that perspective. They're recognizing that they have to get to profitability, get to gross margin positive, get that first-of-a-kind facility done with the financial tools that they have on hand right now.
It's a really good observation. How are you seeing, and I guess this is for any of you, how are you seeing the difference between Europe and the US, in particular, to your point, a lot of uncertainty in the US right now, and when you're looking at going from that pilot to commercial scale for the last couple of years, in particular with the IRA, the US government did a lot of the sort of backstop for that. What do you see as the opportunities in the US, perhaps? And then in Europe, how do you see yourselves reflecting or reacting to the changing environment, and what do you see as opportunities there?
I'm willing to go first. It's changing rapidly, like doing from pilot stage to large scale. The US was such a better place on multiple dimensions, the capital, both the private and public. But I think what's also a huge gap between Europe and US is the scaling expertise. So it's both the managers that have done it before, the venture capital managers, but also the operators and the founders. There's so much. Every time I speak to a US fund, it's like, oh, this ex-Tesla employee or ex-SpaceX employee that built this gigafactory before is now the CTO or whatever. So there's a huge difference. I think it's great that Europe seems to be stepping up on two fronts. So it's both a lot of US companies we see in our portfolio that trying to really, not pivot the whole company to Europe, but their commercial operations and like building their first-of-a-kind plant in Europe and like really trying to get their offtake in Europe. getting European companies on the scale that we've seen in the US grow from pilot to commercial stage, I'm still doubtful how fast we are on that scale. Obviously, we have some like amazing outliers in Europe that were almost there, like Northvolt, or like on that path, like H2 Green Steel, that raised a ton of capital and really building on a humongous scale. But I think the US entrepreneurship and the founders like really go big or go bust. We don't see that big in Europe yet, but curious also with the EIB and the industrial, the new Clean Industrial Act. There's a lot of capital coming online, but there's still a lot of things we need to solve in Europe before we can get to that stage that we have seen in the US.
So yes, I agree. I mean, it's very hard to see a shift so quickly, but I think we are stepping up. I think they have announced the Clean Industrial Deal, and within the Clean Industrial Deal, which is a key piece of strategy for the European Commission and Europe, is really trying to support clean tech and the tech EU. So this hub create this new ecosystem, and so they really want to deploy net zero technologies. They want to continue support the competitiveness of Europe, and they have indeed several. They are targeting more funds to support this growth. So they have this, it's called Innovation Fund, which is grants, and they have boosted that with the 100 billion. They are trying to support through the EAC. So they're trying to really build a new ecosystem. The EAC is doing so much for early stage companies. And then, of course, we lack the size, as Bas was pointing out, we lack the size of scaling and capital fund from the US. But I think there are, also I met them here, there are more actors coming in, which can complement our funding and the existing venture capital funding that there is in Europe. So together with the regulation and the support, I guess, from the European Commission and this Clean Industrial Act, I think we can do more. We ourselves are trying to come up with a new product for advance payments and performance bond guarantee for advance payment and performance bonds to try to encourage as well that piece of support for the clean tech manufacturer, because we think that it's very hard for them nowadays to get some working capital facilities. They have to provide a lot of collateral, and that piece sometimes comes from equity or venture debt, which is expensive. So we are trying to solve that small piece as well, and that's now in discussion. So we hope that will contribute as well to all the challenges that we are facing.
Sort of building on a couple of things that were just said. First, you have to just differentiate what scale you're talking about. There are actually a number of companies that were backed that are ready to start deploying projects and building facilities. And so those companies are very different from the early stage companies that are just in product development mode or early stage proof points. So I'll try to be as specific as possible, but without not giving away confidential information, which I've accidentally done on stage historically, so I'll really be careful. But one example is electric hydrogen, a green hydrogen company, PEM Electrolyzers. We have a project that is a 100 megawatt scale project that's not announced, and that's going to happen in the United States, and that is a deal, a closed customer, and just waiting on announcement. That's a really exciting project, but that was done with some very specific circumstances. Electric hydrogen is working very actively in Europe. We are doing FEED studies, which are the early engineering studies that need to be done before you get approval. We have something close to or over double-digit numbers of those in process in Spain, in the Nordic countries, some in Germany. This is where the action is going for in hydrogen, and that's due to the cost of our product, which is really robust, really good, cost advantaged, but also to the sort of the incentives, the regulatory mandate, and things that are happening here that are much less settled right now with the Trump administration in the United States. We could dive into what's going on with the Inflation Reduction Act, but that's a rabbit hole that we don't want to go down. Another company that's in our portfolio, Form Energy, we have a long, vast pipeline of signed contracts and POs, and we are working to deliver our first contracts on that. For Form, the action is going to continue to be in the United States. There's a strong economic value proposition, a product market fit. We have customers who have identified why to buy this product economically and with state mandates that sort of support the rollout of the product. So for them, it's just get the first projects deployed, demonstrate their efficacy to the customers, and then those continued ongoing signed deals will happen. And then, just as a third example, Boston Metal, which is working on decarbonizing steel manufacturing, has a first facility in Brazil, where we're actually going to be rolling off a non-steel product and developing iron and steel products domestically in the United States in the years to come. And so that's sort of a third approach of how to navigate these kind of choppy waters. Well, the United States will know a whole lot more in about 6 months what the regulatory landscape looks like as the Senate and Congress, House of Representatives go through the reconciliation process. And that's sort of when this uncertain choppiness will start to smooth out. Better, smoother waters. Can't say which way the current will be going at that moment in time, though.
I appreciate that you're willing to put a timeline on it.
Well, the reconciliation process actually has to be done by something like September, October. U.S. politics is a messy cauldron of unpleasantness, but it's going, and that's a deadline.
Yeah, thank you. I'm curious about thinking, you mentioned the government piece and sort of why you'd come here versus be in the US or vice versa. We've got a company in our portfolio called Fervo, which does enhanced geothermal energy in the US right now. And we funded a project with them to fund an apprenticeship program, which in turn unlocked a pretty significant tax credit. And I'd love to hear reflections from the three of you on what other creative mechanisms have you seen, Europe, US, anywhere else, to unlock some of those more interesting flows of money, whether through tax credits or through other mechanisms. What are you seeing from your different perspectives?
Well, I mean, Fervo, we're also an investor in Fervo, a great company, but really what they're doing is they have, I think somebody mentioned it on an earlier panel, they have a source of firm, dispatchable, zero carbon power, right? And that is a really differentiated asset and asset class. If you know about the electricity markets, something that's dispatchable without the intermittency and the lower capacity factors of solar or wind, but has the same carbon characteristics is incredibly valuable. Right now in the US and probably globally, one of the biggest drivers of the electricity markets is not just power, not just not just dispatchability of power, but speed to generating new power and new generation assets. If you want to build a combined cycle gas plant and you just place an order with GE Vernova, you've got something like a 3 or 5 year wait list on the queue, and if you're a hyperscaler data center operator, that's not good enough. So if you can deliver clean, firm power, or they don't care, if you can deliver firm power in 2 or 3 years instead of 3 to 5 years, then they will buy it. And so that's a company like Fervo is working to deliver against it. That's also a value proposition for Form. That's a value proposition, that some of the nuclear companies can't quite hit because they're like maybe 5 or more years out, but they're still getting these long-term contracts. So identifying where there's a customer who has a need for the product that you can have and the value proposition that you can identify, in this case, the change for many of those companies is the speed with which they can deliver the power is a game changer for those customers.
Great. Any reflections from the other two?
Yeah, no secrets or whatsoever, but I think at least in Europe we're seeing really more capital coming from different pockets. There's the ETCI that just funded a new European deep tech growth fund with a 350 million ticket, really addressing something that's missing. We see a lot of the sovereign wealth funds, but also the EIB and EIF stepping up. I think what's still hopefully will be solved, a bit missing, it's still very localized. So we're gonna help this German hydrogen company with tens of millions, and we're gonna solve this problem in Italy for this company. And I hope within the Clean Industrial Act and new EIB loan programs, we can replicate what the US has done, and like really at central level, not in the millions but in the billions, really trying to pick the best companies, and not like we hear examples in the US of portfolio companies getting a call from the government like, hey, you've been selected for this program, here's some capital. Like in Europe, you just need to wait too long. So if we can solve those things, I think there will be a lot of like new clever ways of getting capital to European companies. Also curious, like Gabriel, I mean, a ton of your companies benefited from this, and obviously the loan program and IRA, we're not going to dive into it, but what are some of the things you would hope if we replicate this in Europe? We really need to do well to replicate this success, and what are some of the learnings you've seen there?
I've a bunch of companies in our portfolio have received grants and packages and incentives from the federal government. I don't know one of them that actually got a call out of the blue saying, "Hey, congrats, here's your money."
I'll get back to you on that one.
It's a hard process, but you have to be prepared to take advantage of it. I think, we were talking about this earlier, I think there's a tremendous opportunity right now for the EU writ large, and then for, nations within the EU to actually capture activity that has historically been in the United States. And that's just because we've got an administration that's actively hostile to most of these sorts of projects, and hostile to a discussion of climate change as a driver for wanting to do a different sort of infrastructure and project development. And if Europe can figure out how to adopt kind of tech neutral or even tech supportive policies that bring those first of a kind facilities to shore, to land for projects that help companies establish beachhead markets, first customers, even factories here, that can be a long-term economic advantage. We, unfortunately, in the United States, seem to be in the process of dismantling a system of research, development, academic support that has for decades, literally, been a source of long-term economic growth. That's frightening from a US and from a global perspective, but it means that other geographies, if they can act fast and we continue on the course we're going, can take advantage of that. I think we might be in a fundamental shift from like a Bretton Woods kind of neoliberal international policy space to a much more nationalized, instead of an energy trade economy, we're in an energy security economy. We're building, instead of building a small garden with high walls around national security, the United States seems to be building high walls around everything, the 90-day change in the tariff policy notwithstanding. Like, this is an opportunity for others to build up those industries in a way that they should take advantage of.
Yeah, absolutely, I agree. I think this is the occasion for the EIB, to really rise. For Europe to rise to the occasion, and I think the Clean Industrial Act was one way to respond to this, to the IRA, but also to other Chinese industrial subsidies, but also there is the EU. There's discussion now for the EU 28 regime, which is sort of fiscal and simpler reporting specifically for startup and small small and medium-sized companies. But I agree. I mean, it's our opportunity to support the companies in Europe. We have consistently, I think, supported cleantech and sustainability goals. So hopefully we will continue to do that, and maybe we will see some companies coming from the US to Europe.
I think we will. I really
Very
do.
much so.
Rather than the other way around, but we need the capital to help them scale maybe in Europe and have the manufacturing. There is support for all the industrialization and the manufacturing. We want to see that for the clean technologies. So hopefully we will find the capital to support the companies, because I think it's really a cultural issue, right? I mean, the US, you have a different risk appetite, which is not that easy to just.
That's right.
Change, like mentality change. But hopefully this is an occasion for us to do it, to start thinking differently.
Yeah, just to add on to what you're saying, there's also another aspect to it. For decades, not years, for decades or for generations even, the United States was the place where smart, young scientists, researchers, academics wanted to come and do work. Absolutely. Right? Like they wanted to come and, up and down the academic ecosystem, they wanted to come. And now, if you're a rational, non-US citizen, you're thinking, why the heck would I want to go there with all that's going on? And that's an opportunity for countries. It's a long-term thing. It's not 3 years or 5 years, but to get that talent to come to Spain, to France, to Germany, to wherever, and set up their lives there instead of in the United States, that's a long-term shift that, as an American, I hope doesn't happen, but if I were a European or a nation within Europe, it's not a monolith, I'd be saying, this is an opportunity, and this is a generational opportunity, not a decadal opportunity.
I think the interesting thing in Europe, we already have a ton of scientists. I think we even hold the most tech-related or climate tech-related patents, but we just lack the scale, operations, and the capital. So I think it's great, not what's happening in the US, but at least for Europe, we have a better shot at creating some of these companies here, and it's obviously great for climate. The open question for me is for the VC side, who's actually going to benefit from this? Is it some of the US companies like electric hydrogen coming into Europe and maybe pushing some of the EU companies out? And is it the US venture capital funds eating the lunch of the early growing European climate tech ecosystem? Because we see a lot of US climate funds now opening offices in London, Europe, looking more to either with their portfolio companies to deploy projects here. We see Rondo, with a lot of support from the EIB, which is amazing, coming here. Electric hydrogen, I would welcome Vervo as well. But who's actually going to be the winner from the VC side? And I think the Americans will do probably a good job in Europe as well. Are you looking more into Europe, Gabriel? You're welcome.
It's something we're actively looking at and thinking about. We haven't made a commitment yet. We haven't made a decision yet, honestly, just completely openly. But I think one of the challenges that still exists here in Europe versus there, if you think about what makes an ecosystem like Silicon Valley successful as an ecosystem for company development and growth, it's a combination of things. It's the capital, it's the intellectual talent, it's the founders and all of those things that we've talked about. The other thing that you don't quite realize unless you've lived and worked in Silicon Valley or lived and worked in the Boston area or one of those centers of entrepreneurship is that if you're a company and you're hiring engineers, you're hiring software talent or hardware engineering talent, you've got this pool of employees who have this attitude like, I'll go work for this startup. And this startup may not be here in 2 or 4 years, or it may turn into a really big success, and I'll have some equity in that startup. and I'll make some money. And if I do that for 20 or 30 years, I'll have the same benefit as if I worked for Apple or if I worked for IBM back in the day. And you build this career and you have not only entrepreneurs founding the companies, but you have this universe, an ecosystem of entrepreneurial employees. And if you're an engineer and you live in Sunnyvale, California, you can do this and never move your kids and never move your family for like 30 years and have worked for 5 or 6 different really exciting tech companies. And you think about and build your career that way, even if you're not the founder. That is difficult to replicate. That takes time.
So maybe wrapping with one question from the founder side. We've got some CEOs in the room. What are skills you're seeing that are maybe new that you need now? That maybe in the old days it was raise VC and that's kind of the thing and then we move on, but now we've got all these different sources of capital, dilutive, non-dilutive, all sorts of different entities. As a founder, what should I be thinking about to enhance my skill set to be able to run with some of these ideas?
Yeah, I don't know. I mean, we're trying we're trying to explain to the founders and to their startup, like exactly at this conference is how our product works, and we try to explain that this is complementary. So we're trying to offer them an overview of all the possibility that they have. So starting from the EAC, as I said, I think they're doing a fabulous job. I think some of the National Promotional Bank in Europe are doing also a very fabulous job of nurturing companies from the very early stage. And then we say, the VCs for the equity, for the risk, and then when you get a bit bigger, you've done your Series A, you've done your Series B, then you can think about venture debt. So we are trying to tell them how to look at it and have a clearer view for themselves of their path to profitability, how they want to reach the scale. So this is what we're trying to do as well.
Yeah, I think that's right. Like it's not raising equity and venture capital that's the skill of the CEO and the CFO and the team. It's funding the company and funding the first factory and funding the first plant, the first of a kind plant. And you have to be good at that, not at raising equity. That's exactly right. The other observation I'd make, if you're a founder, if you're a CEO, or if you're part of the founding team, you're building a product, you're selling a product. But the machine that you're building, the thing you're really building, if you're the CEO, if you're that team, you're building the company. Like that's your responsibility. Keep the lights on, let your employees, help your employees, enable your employees to do the work, to build that company. And it's really important to have a team in place who knows what that machine that they're building looks like. If you're a fresh out of your PhD, brilliant inventor, and you don't know what 100 and 200, 300 person company looks like because you've never worked in that place, find a co-founder, find partners who do, because that's the machine that you're building. That's the thing that you're creating. And if you don't know what that looks like, if you've never been in that, then how can you build it?
I'll be very short because I see a lot of red signs, but as we're both investing in Europe, US, we do see a very strong difference in how CEOs are able to, or founders are able to sell their company, their product, and also the equities. I think a lot of European founders can maybe learn a thing or two how Americans are able to sell, and it comes to equity, it comes also to the debt programs, to convincing other people to join, to find this mentor that actually was able to scale companies successfully, but be a bit more commercial. And in Europe, I think a lot of people are still too humble compared to what they're building.
Wonderful. Well, thank you all for your attention. I think it is actually lunchtime now, and thank you, Greece, for participating. Really appreciate it.
Thank you.
Good rest of your time.